broader dynamic is still very much about being, on the US market. I mean, for the past 10 years, investors have been, buying US equities because there was nothing else to buy. And I think positioning is still very much tilted to the US. And I think the pen trade for global investors is basically something going wrong in the US. If you see a more hawkish Fed, and if the data, the earnings stories start to deteriorate, and we are seeing that with a bunch of mega cap, big tech companies in the US. If you see the kind of bullish or consensus view on the US, being challenged, I think that will be a clear pen trade for investors who are very long US in their allocation. On the other hand, I think the bar for Europe to surprise on the upside is not that high. Of course, things are not great in Europe, but no one would disagree with that. And at the margin, things are not getting worse. So I think within a fairly unappealing, outlook for equity market right now, I think the relative value of Europe is playing in its favor. And as it stands, the kind of catalysts are a bit more favorable to Europe than for the US.
Let me focus on a couple of sectors specifically then in Europe. And I agree with you. I think people have been trying to write off Europe a little bit too much over the last quarter. And one of the surprises, I think, has been the drop in energy usage we've seen across the continent as companies and individuals have tried to adapt to higher prices. What we now see is that some of these headline energy prices are dropping below pre-pandemic levels and pre-Russian invasion levels of Ukraine. What kind of companies that are energy intensive are going to benefit from this drop in input costs if this remains the story across the rest of this year, and should I buy them?
Well, I mean, all else equals, there should be a support for the kind of broader industrial, complex materials, chemicals, which, you would find a lot in the DAX, in the German equity market. This is what suffers the most. If you think about which market were hurt the most by this broader stagflationary dynamics in 2022, it was basically Germany, Sweden, so this kind of very heavy industrials, chemicals, materials indices. So that's what should see the kind of early relief on this kind of disinflation front. I also believe that some of the consumer sectors, maybe autos, retail, should feel a bit better because the cost of living crisis is not gone, but I think the intensity of the shock is somewhat reducing, and that might provide a bit of a floor to the economy. So I think consumer cyclicals, industrials should be supported here. And again, on top of that, you are seeing a little bit of support from China reopening, which should also help some of the cyclicals in Europe.
Excited about European healthcare. I think we have some world-leading companies in Europe. And yet, as I look at a Stock 600 chart of the healthcare sector, the best of it was had back in April in terms of the sector as a whole. And we've had a few rallies across the last 12 months, but we've never regained anything that looked like that earlier peak. That's obviously just a one-year story, but I'm interested as to why I should be excited to go back into this sector this year when it seems that investors are still hungover, I think, from the COVID spikes.
Well, look, don't ask me about being excited about healthcare because we are not excited about healthcare. We sold our kind of long position 3 months ago on the view that when the bulk of the dollar appreciation is behind us, and healthcare was a key way for us to be exposed to the US dollar. It's a dollar earner sector and worked very well through 2022, but we think this is old story now. We are kind of less bullish on the US dollar, but also we think that the valuation of the sectors, the earnings momentum are looking less favorable here. What we did was to swap healthcare for staples. Staples had a very tough year in 22. If you exclude tobacco, food and bev was one of the worst sectors last year, despite its defensiveness. And we see that into the new year. Well, firstly, you have this kind of exposure to emerging market, to China, that should play more in favor of staples. And at the same time, we have a view that margins, earnings will be quite resilient for staples compared to the rest of the market. So, we swap healthcare for staples. It's a kind of beta neutral trade, but we think staples have maybe a bit more of a support from EM recovery, but still giving us a bit of defensiveness in the portfolio.
Emmanuel Cau, thank you so much for joining us, Head of European Equity Strategy at Barclays.